How to build wealth and make money doing nothing. Hey, this is Justin Hitt from Sustainable Wealth Secrets. I want to assure you this is not some business opportunity where you make money while you sleep. It's more of an understanding of the current and future value of money and the application of capital so that you are generating a return rather than taking significant risk and facing a loss. Warren Buffett talks about the first rule of investing is to not lose the money, and the second rule is to observe the first rule. The key here to understand is that money invested has both opportunity cost and the potential for gain. When you calculate in advance, while you're making a decision about where to put that money, you can calculate building in a low risk cost. So if I invested this money in a low risk investment that generated a fixed return, what would it be? Most of the time you use 4% for that factor. You can also look at if I invest this money now, over time, how much do I lose to inflation? Usually you estimate that at 4% as well. So there's almost 8% in that money for it to stay have the same buying power. So today you have $100. In 10 years, you want to still have $100 worth of buying power, even though the dollar amount would be greater due to inflationary activity. So here's my point. The government's going to do a large project. They're going to do a railway system. The railway system costs $34 billion to produce $1 billion in return. It's about a 5% return. I'm just using very rough numbers here. They have to ask themselves, if we took that $34 billion and put it into the markets, would we get 5% or a better return? And in many cases, there are investments where you can get a consistent 4 to 8% return on your money without doing anything other than making a decision about where you place the capital. So that's really what I'm getting at. You can earn by placement of capital versus any other option available, and it can be calculated in advance. So you can say, hey, I've got a choice of two investments. I could put my money in the stock market, or I could buy a house. If I buy the house, I have these ongoing holding costs. If I buy the investment, I have these ongoing taxes. Either way, you can lay out both sets of expenses, both sets of capital outlay, and you can make a decision about what's the best thing to do with $100,000. So maybe your choices are invest in the stock market and continue to live in an apartment, buy your own home, or buy an investment property. Each of those decisions have different tax consequences. They have different holding costs. They have different future value of the asset purchased. Again, what I advocate in Sustainable Wealth Secrets is that you can calculate this in advance. Now, you can't know that the house is going to appreciate 20% over the next 10 years. You can't know that. You can have an estimate. You can look at factors and historical rates. You can look at the characteristics of a neighborhood. You can't know that a stock market, so most S&P 500 stocks over a 20-year period have about a 10% gain, and that's just kind of historically how it happens. But you can't know that while you're holding that the economy is not going to crash and you're going to need that money to cover something else. And where the economy crashes, that stock money may not have as much value as a physical asset such as a house. So you're not going to know these things. But you can in advance ask the question, if I have $100,000 today, how much money do I need in 10 years to have the same buying power as $100,000 today? So you can calculate the future value of the money. If I'm going to invest the money here and I'm taking it out of a fixed income type investment, then how much do I need to earn so that my new investment is worth more than my existing investment? Do you see how this works? Now, if you take a finance class, you will learn these things. If you take an economics class, you will learn these things: supply and demand, future value of money, economic, what is your cost of capital? What's your debt to income ratio? I'm arguing that these things are relevant to every high income professional. Every mass affluent individual, every individual who has a business or invests in property. Because what happens is it tells you when an investment is no longer viable and those assets may be better allocated somewhere else. Now, I understand a lot of people fear. So maybe you own a bunch of rental properties and you're noticing that the value of the properties are increasing significantly and the government's talking about fixing rents, rent controls. You now have to make a decision. Do I stay in the investment properties and gain the net asset value or the net worth value, yet risk the potential for my rents to be forced lower than my actual costs? Or do I sell all the properties now and then later in the future when property values are more favorable, buy properties back again, but meanwhile invest that money in another area that has the potential for growth, or at least the potential to not lose value? Can you see how this works? And it's almost magic in some ways. You can do nothing with a project. I know high income professionals who are talking about, I'm going to start a business and I'm going to buy rental properties and I'm going to just roll this money over and I'm going to get rich in Bitcoin. And I say to them, well, how do you know? And they say, I just got a feeling about it. And I said, great, let's do the math. We did the math and they realized, okay, you're not even getting into an investment property unless you have the $25,000 necessary for a down payment and then about $5,000 to $10,000 to get the property at a value that it meets market rates. And then $10,000 to $15,000 a year to maintain that property because it has these capital expenditures that are going to be expected. And then when you start calculating at least minimum wage for the time it's going to take, you're now facing a losing battle before you even started, and you were better off just keeping the money in place until you had about $250,000 in cash available. Because again, one rental property isn't going to do a whole lot for you unless it's an apartment building and have multiple units. You need more units. The more units that you get, the better stability that you have when it comes to rent. And then a lot of folks just look at it and they say, oh, I didn't realize it was that much work. Or, oh, that's not such an opportunity. I need to be looking for a different kind of property. Or, oh, minor adjustments in my existing portfolio helps me focus my energy on income categories that I already have. So instead of being the business, the rental properties, the Bitcoin, I'm going to pick one and focus there. It's that kind of mindset that sustains wealth. It's that kind of mindset that when you start seeing economic conditions change, that you can shift the capital you have, multiply it, and then take the proceeds from one investment and diversify into another. Now, you can experience this with a balanced stock portfolio. I've got a whole program about the balanced stock portfolio, 5 simple ETF funds. It doesn't really matter which ETF funds you have as long as they have parities, and ultimately you can learn how it works there. And the example is pairing the S&P 500 against the bond fund. There are times where the bond fund is going to yield better returns than the S&P 500 overall, especially if you need to have access to that cash in the near future. And then there's other conditions where you're going to have a much longer time horizon and you can have 90% in the S&P 500 and just 10% in stocks or in bonds. And it depends on your tax situation. Maybe you buy the bonds directly to reduce your tax liability. Again, this is why I recommend you work with a financial advisor. This is why I recommend you work with a CPA. I can help you with strategy. I can introduce you to concepts. But when it comes down to the numbers, the calculations tell the truth. You can compare 2 or 3 scenarios on paper. It doesn't cost you anything but a pencil, a paper, and a little bit of time on a calculator. With the formulas, future value of money, earnings before taxes, your debt cost of capital, your debt ratios, all these things tell you something about your position and help you set up wealth by design. It helps you earn even when it seems like you're doing nothing. Now, of course, you now know that the work you're doing is front-ended. It's the work of finance and economic decision making, and it's what guarantees long-term wealth. Now, it could cause you to be more conservative than you would be otherwise, but I got into the silver market when it was booming. I sold out about midpoint. People were telling me I was an idiot for selling out, but they were still holding the bag when it had dropped. I had already moved into another market. It doesn't really matter what market people were moving in and out of. I was moving into areas where I had skills. I moved into areas where it amplified income. I moved into areas that were counter to the popular word. And personally, when the news is talking about Bitcoin and the news is talking about NFTs, non-fungible, I don't know what they're, smart contracts. If the news is talking about it, it's already too late. You shouldn't be in there. The news is what they call, and we talked about this in another episode, the news is used to pump while the investors are doing the dump. They need that new money into the market in order to get out. Housing bubbles. Zillow was buying up a huge mass number of houses, and suddenly they realized it isn't functionally valuable to them. It isn't going to produce the returns that they're looking for, so they simply dump those houses. There are times where these calculations will reveal that you need to dump an investment today at a loss to avoid additional losses in the near future. Some of these calculations will tell you that that you need to rapidly downsize in order to free up capital, and you'll know that number for the capital in order to get in on an investment that basically gives you greater diversity. So you have more cash, you can spread that money around a little bit better, greater diversity, rather than starting now with a small amount of cash in an investment that has a significant risk. Again, these are factors that we can talk about, but I'm going to have you bring a tax advisor in. I'm going to have you bring a CPA in. I'm going to have you bring a financial advisor in, at least to check your numbers. Because again, there are times where you're better just stuffing the money under your mattress, not literally, but stuffing the money into a high yielding savings account, or because you have a near term cash expense, putting them in your 401k or your retirement account because you have this longer time horizon, converting one type of retirement account to another type of retirement account because you have a low tax situation this year. There is no one and done strategy for building wealth. And I don't know how I got to get this to people. I don't have to hit them over the head or something, but there's never, ever a one and done strategy. Over your lifetime, you're going to have 3 or 4 strategies that work well for you. You're going to move in and out of these different strategies as the market conditions dictate, as your calculations dictate, and ultimately what you'll be able to determine from a cash flow report is what is your yield. Of the capital you have, what are you able to produce? If you're able to produce 5, 10, 15% on your money, there's different decisions. But if you find that you're constantly losing money, that you're losing buying power, that you don't have free net cash flow, that you're accumulating debt, then now is the time to make a change. It's okay to change. You've got to be immune to the opinions of the general market, because if the general market was right, everybody would be rich. Everybody would have a surplus of capital. Sustainable Wealth Secrets is about you gaining a surplus of capital. It's about you getting a greater return on investment that is not depleted by your cost of capital. And it's about the leverage that debt can bring you to buy assets that cash flow. I want to thank you for being a part of our program. I'm Justin Hitt from Sustainable Wealth Secrets. If you have any questions about this or anything else that we cover in the newsletter, visit me at www.sustainablewealthsecrets.com. This money math can help you make money doing less, because it helps you make better financial decisions. We're all about affluent individuals and high-income professionals transforming their income into wealth so that they can be more independent, have greater financial freedom, and be able to make the decisions that are necessary for their family to have the lifestyle that they desire. Thanks for listening.